Welcome back to the channel. Today's video is all about capital gains tax and a potential change that could affect a lot of people, especially those involved in property. Right now, the Labor Party is exploring ways to bring in more revenue. Government spending is already extremely high, and with current tax levels already stretched, they're looking at alternative ways to raise funds. One idea on the table is to increase capital gains tax, while at the same time reducing income tax and possibly even removing national insurance. In this video, I'll break down what's being proposed, what it could mean in practice, and also look back at when a similar idea was considered before and what happened as a result. Before we go any further, if you're new here, consider subscribing and turning on notifications. This channel covers property news, house prices, interest rates, and investing insights. If you find this useful, a quick like on the video really helps the channel grow. Now let's get into it. At the moment, taxation in the UK is already at a very high level, arguably higher than it has been since the period following World War II. And historically, when taxes rise too much, it tends to slow down economic activity. You can actually see that reflected in the data. Growth has been weak, and it feels like the economy has been stuck without real momentum for quite some time. Looking back when Labour was last in power, VAT was adjusted a few times. It dropped from 17.5% to 15%, which helped ease pressure and support the economy. But not long after, it was raised again to 20%. Since then, we've continued to see layer upon layer of taxation, income tax, VAT, and more, adding to the overall burden. Now, Labour is reviewing a new policy paper that considers shifting that burden. The idea is fairly straightforward: reduce taxes that affect the majority, like income tax, and make up the difference by increasing taxes on gains, such as capital gains tax. It's important to understand that capital gains tax doesn't only apply to property. It can also apply to investments like stocks, shares, and businesses. However, for many people watching this channel, it's most relevant when selling a second property, particularly buy-to-let investments. If this tax is increased, it could have a direct impact on landlords. In some cases, it may discourage people from selling because they'd have to give up a larger portion of their profit. That could effectively keep more landlords in the market, whether that's intentional or not. There's also a broader concern here. Higher taxes on gains can reduce the incentive for people to invest, grow businesses, or take financial risks. From an entrepreneurial standpoint, that's not always a positive signal. So why would the government consider this? Well, reducing income tax is something that appeals to a wide group of people. Not everyone pays capital gains tax, but almost everyone pays income tax. So from a political perspective, lowering income tax while increasing a less widely paid tax could be seen as a strategic move. On top of that, there's also discussion around removing national insurance. That's another major cost for both employees and employers, and reducing or eliminating it could leave more money in people's pockets. In theory, that could lead to increased spending and potentially support economic activity. Of course, to balance the books, the lost revenue would need to come from somewhere, and that's where capital gains tax comes in. This isn't the first time this idea has been considered. Back in 2020, under the Conservative government and Rishi Sunak, a similar review took place. At the time, the government was spending heavily due to the pandemic, supporting businesses, funding furlough schemes, and offering financial aid to keep the economy afloat. They explored increasing capital gains tax as a way to recover some of that spending. In the end, the policy didn't go ahead, but even the discussion alone had a noticeable effect. Many landlords began selling their properties in anticipation of potential tax increases. Over time, it's estimated that around 7 to 12% of rental properties left the market. That shows just how powerful expectations alone can be. This is where things get complicated. Frequent changes, or even the possibility of changes, can create uncertainty. And when people feel uncertain, they often act quickly to protect their position, which can lead to wider market shifts. From my perspective, a more effective long-term approach would be to focus on efficiency and growth, creating an environment where businesses can expand, jobs can be created, and overall economic activity increases. That, in turn, can naturally generate more tax revenue without constantly increasing rates. That said, we have to deal with the reality in front of us. If labor moves forward with this plan, it's likely that many people who hold assets, like property or investments, will face higher costs when selling. At the same time, a much larger group could benefit from reduced income tax and lower overall deductions. And because of that balance, there's a strong chance this type of policy could gain support and potentially be implemented. As always, the goal here is to keep you informed, especially if you're involved in property, so you can make decisions based on what's happening in the market. Let me know your thoughts in the comments. Do you think this is a fair trade-off, or does it create more problems than it solves? Also, if you're a landlord or a tenant, make sure you're up to date with the Renters' Rights Act requirements. There's an official information sheet available, and it's something landlords need to provide to tenants within the required timeframe. Failing to do so could result in a significant fine. Thanks for watching. If you found this helpful, don't forget to like, comment, and subscribe.